The U.S. Panic of 1907, J.P. Morgan's intervention, and the birth of the Federal Reserve. Certainly, the Panic of 1907, also known as the Knickerbocker Crisis, was a severe financial crisis that had widespread implications for the United States economy. Here's an extended story on the Panic of 1907. At the turn of the 20th century, the United States was experiencing a period of rapid economic growth and financial expansion. However, this prosperity was accompanied by the emergence of financial speculation, particularly in the stock market, and the increasing complexity of the financial system. The roots of the Panic of 1907 can be traced back to various factors, including a speculative bubble in the stock market, the inadequacies of the national banking system, and global economic conditions. One of the key triggers was the attempt to corner the market in shares of the United Copper Company by a group of speculators led by F. Augustus Hines and Charles Morse. When their scheme failed, it set off a chain reaction of events that exposed vulnerabilities in the financial system. The crisis unfolded in October 1907 when a series of bank runs and failures occurred. Trust in the banking system eroded rapidly as depositors rushed to withdraw their funds from banks that were perceived to be at risk. The crisis reached its peak with the failure of the Knickerbocker Trust Company, a major financial institution in New York, in late October. As the panic spread, there was a lack of a centralized institution or mechanism to provide liquidity and stabilize the financial system. This led prominent bankers and financiers, including J.P. Morgan, to intervene in an attempt to restore confidence and prevent a more severe economic downturn. J.P. Morgan played a central role in resolving the crisis. In what became known as the Morgan Panic, he assembled a coalition of bankers to provide financial support to troubled banks and stabilize the markets. Morgan's efforts included the infusion of his own funds and the coordination of a consortium of banks to lend money to institutions in distress. The crisis prompted a reevaluation of the nation's banking and financial systems in the aftermath of the Panic of 1907. There was a growing recognition of the need for a more robust central banking mechanism to provide stability and prevent future financial panics. This sentiment ultimately contributed to the establishment of the Federal Reserve System in 1913. The Panic of 1907 had significant economic and political implications. It exposed weaknesses in the existing financial infrastructure, prompting calls for reform and regulatory measures. The crisis also highlighted the role of prominent individuals like J.P. Morgan in shaping the course of events during times of economic uncertainty. The aftermath of the Panic of 1907 left a lasting impact on the United States approach to financial regulation and the management of economic crises. The lessons learned from this episode influenced the creation of the Federal Reserve System, which was designed to provide a more flexible and responsive framework for monetary policy and financial stability. While subsequent financial crises including the Great Depression of the 1930s, would shape the trajectory of U.S. economic policy. The Panic of 1907 remains a pivotal moment that spurred reforms and laid the groundwork for the modern financial system.